$38 trillion. Not a forecast, not a projection. That's how much debt the United States is carrying right now. And here is the part almost no one is talking about. While everyday people argue online and binge another episode, the world's largest financial players are quietly repositioning trillions of dollars behind the scenes. No breaking news alerts, no dramatic headlines, just silent, deliberate movement. This isn't fear, it isn't theory, it's numbers, filings, and history repeating itself. By the end of this video, you'll understand why the smartest money on earth is preparing for what comes next, and why ignoring this moment could cost you everything. Global debt has reached levels never seen in peacetime history. According to international financial data, total worldwide debt now exceeds $250 trillion, far outpacing global economic output. The United States alone has added more than $2 trillion in new debt in less than a year, pushing its total beyond anything previously imagined possible. On paper, these numbers feel abstract. Trillions don't feel real. But debt isn't just a number. It's a claim on future productivity, future taxes, future purchasing power. And when debt grows faster than the economy that supports it, something always breaks. The real problem isn't just how much debt exists. It's who holds it, how it's financed, and what happens when confidence fades. Modern economies run on trust. Trust that currencies hold value, that governments can repay obligations, that financial systems will function tomorrow like they do today. When that trust cracks, consequences arrive fast. History shows us something uncomfortable. Every global reserve currency eventually loses its dominance. Not because of bad intentions, but because mathematics always wins. Empires expand, borrowing increases, spending accelerates, and eventually debt becomes too heavy to sustain without currency debasement. When that happens, inflation isn't an accident, it's policy. Governments print to survive. Central banks intervene to stabilize markets. Asset prices inflate, but wages lag behind. The middle class feels richer on paper, but poorer in real life. The most dangerous phase isn't collapse, it's the period right before it, when everything still looks fine. Markets hover near record highs. Confidence remains public. But quietly, institutions that understand balance sheets begin preparing exits. That's where we are now. Not in panic, not in crisis, but in the most deceptive phase of all, the moment when risk hides behind normality. This isn't the first time the world has seen this setup. In fact, it's happened 3 times before with almost surgical precision. Different centuries, different empires, different currencies, same pattern. Each time, a nation rose to financial dominance. Its currency became the backbone of global trade. Capital poured in, wealth expanded, confidence became absolute. Then, slowly, borrowing replaced discipline. Military commitments grew, social spending expanded. Debt rose faster than productivity. For decades, nothing appeared wrong. Markets soared, real estate boomed, people believed prosperity was permanent. Then came the moment no one noticed, when large institutions began moving money quietly. No announcements, no warnings, just systematic reallocation away from the dominant currency. That phase always lasted a short window, usually less than 3 years. After that, collapse followed rapidly. Reserve currency status faded. Inflation surged. Asset prices fell together. Savings were destroyed. Entire middle classes vanished. Spain experienced it in the 1500s. The Dutch Republic lived it in the 1600s. Britain faced it in the 20th century. Different eras, identical outcomes. What makes this moment different isn't the pattern, it's the scale. Never before has a single currency underpinned as much global debt as the dollar does today. Never before have so many financial systems been so interconnected. And here is the uncomfortable truth. By the time mainstream media agrees there is a problem, the opportunity to prepare is already gone. This video isn't about predicting an exact date. It's about recognizing a cycle, one that has repeated for 500 years. The only variable has always been whether individuals understood what stage they were living in. Right now, all the data points to the same answer. Every major financial collapse in recorded history has followed a structure so consistent, it almost feels scripted. Different centuries, different flags, different leaders, but the same underlying mechanics repeat again and again. The details change, but the architecture never does. To understand where we are today, you have to understand how this cycle works, because once a nation reaches the later stages, outcomes are no longer political choices. They become mathematical consequences. The cycle begins with ascension. A country emerges from crisis or conflict stronger than its competitors. Its institutions appear stable, its economy productive, its military secure. Capital from around the world flows inward, not because of loyalty, but because of opportunity. Investors want safety and returns, and this nation offers both. Over time, its currency becomes the preferred medium for trade. Commodities are priced in it, contracts are written in it, debt is issued in it. Confidence compounds upon itself. This stage can last decades, sometimes generations, and it creates the illusion of permanence. Then comes overextension. Success creates complacency. Leaders begin to assume demand for their currency is guaranteed. Spending expands beyond tax revenue. Borrowing becomes normal, then invisible, then expected. Wars are financed without immediate sacrifice. Social programs grow without long-term funding plans. Central banks step into smooth volatility, lowering rates and expanding balance sheets. Asset prices rise faster than wages. On paper, the nation looks richer than ever. But beneath the surface, the system becomes fragile. Debt no longer grows alongside productivity. It grows faster. Each new dollar of borrowing produces less real economic value than the one before it. This is the turning point most people miss, because life still feels normal. Markets are high. Employment appears stable. Confidence remains loud. The danger is hidden in balance sheets, not headlines. The third stage is the most important and the least visible, the silent exodus. This phase never begins with panic. It begins with spreadsheets. Institutions that manage billions or trillions don't react to narratives. They react to numbers. When long-term debt dynamics stop making sense, capital doesn't flee overnight. It rotates, quietly, methodically. Exposure is reduced in small increments. Portfolios are diversified across currencies, regions, and asset classes. No announcements are made, because announcements move markets. Silence is the strategy. Foreign holders begin trimming reserves. Large corporations expand investment elsewhere. Wealthy families open accounts in multiple jurisdictions. Trade agreements quietly bypass the dominant currency. None of this feels dramatic in isolation. But together it signals a loss of confidence at the institutional level, the only level that truly matters. History shows that once this phase begins, the clock starts ticking. Not years, months, sometimes a couple of years at most. Spain learned this lesson in the 16th century. Flooded with gold and silver from the Americas, it became the richest empire on earth almost overnight. The Spanish currency dominated global trade, but that wealth funded endless wars and an enormous bureaucracy. Spending outpaced revenue by multiples. Borrowing replaced discipline. Eventually, lenders demanded repayment in hard assets instead of promises. Capital moved north. Defaults followed. Inflation destroyed purchasing power. Spain's dominance vanished within a single lifetime. The Dutch Republic inherited financial leadership in the 17th century. Amsterdam became the center of global banking. The world's first stock exchange was born there. Capitalism itself took shape under Dutch innovation. But wars, debt expansion, and hidden banking fragility undermined the system. When insiders realized deposits were no longer fully backed, capital migrated to London. The collapse came later, but the decision had already been made. Britain followed the same path. For over 200 years, the pound sterling was the backbone of global trade. London financed the world. But 2 world wars shattered Britain's balance sheet. Debt soared. The gold standard failed. Quietly, capital and talent moved to the United States. By the time the pound was devalued and Britain sought external bailouts, reserve status was already lost. In every case, the public explanation focused on surface events, wars, politics, leadership changes. But the real cause was structural. Too much debt, too much printing, too much confidence for too long. The United States rose within the same framework. After World War II, its economy was intact, while much of the world lay in ruins. The dollar became the global settlement currency. Markets deepened, institutions strengthened. For decades, discipline remained because constraints still existed. But once those constraints were removed, borrowing accelerated. Debt grew exponentially. Financialization replaced production. Central banks became permanent market participants. For a long time, this worked, or at least it appeared to. Asset prices rose. Consumption expanded. The dollar remained dominant because there was no alternative large enough to replace it. But dominance without discipline always decays. Today, the signs mirror previous transitions. Foreign demand for long-term government debt has weakened. Central banks diversify reserves. Trade increasingly settles outside traditional channels. Major financial institutions reduce concentration risk. None of this means collapse is imminent tomorrow. But it does mean the system has entered the same stage that preceded every previous currency transition. The final stage, collapse, never looks like collapse beforehand. It looks like policy confusion, inflation that won't fall, interest rates that can't rise without breaking something, markets that swing violently, trust that erodes slowly, then suddenly. When confidence finally breaks, the shift is fast. Asset prices deflate together. Debt becomes unserviceable. Purchasing power evaporates. The middle class bears the cost. The tragedy is not that these cycles exist. It's that most people only recognize them in hindsight. The opportunity to prepare exists only during the silent phase, when the system still appears functional and choices can still be made calmly. History doesn't punish ignorance. It simply ignores it. And right now, the pattern is unmistakable. Stage 4 never announces itself with a countdown or a headline. It doesn't arrive with a single crash or one dramatic event. Instead, it unfolds through pressure that builds inside the system until something finally gives way. And history is brutally clear about what that pressure does once it reaches a critical level. When a reserve currency begins to lose trust, demand doesn't vanish overnight. It erodes. Countries start settling trade in alternative currencies. Bilateral agreements replace global standards. Central banks reduce exposure quietly, month after month. At first, markets barely notice. But underneath, the foundation weakens. Here, Zasinyam was the mechanism most people understand. Reserve currency status is what allows a country to export inflation. As long as the world needs your currency, you can print without immediate consequences. But when that demand fades, those excess units don't disappear. They come home. And when they do, prices surge. That's when policymakers face an impossible choice. Option 1, raise interest rates aggressively to defend the currency. That might slow inflation, but it also makes massive debt unpayable. Governments drown under interest costs. Businesses fail. Asset prices collapse. Unemployment explodes. Option 2, keep printing to cover obligations. That avoids immediate defaults, but destroys purchasing power. Savings evaporate. Wages lag far behind prices. The currency dies slowly, then all at once. Every historical case ends the same way because there is no third option. You cannot outgrow exponential debt, you cannot print confidence, and you cannot borrow forever without consequence. This is where people fall back on comforting myths. We have the strongest military. We lead in technology. Our institutions are superior. History destroys those arguments every time. Spain had unmatched military power in the 1500s. It didn't save the currency. The Dutch invented modern finance. It didn't stop collapse. Britain ruled a quarter of the world. It still lost reserve status. Economic mathematics does not care about dominance. It does not negotiate with power. It simply balances the books. Another myth is that central banks can always save the system. They can delay outcomes, but delay always makes the final adjustment more violent. Weimar Germany printed to survive and wiped out its middle class. Zimbabwe printed and destroyed its currency. Venezuela printed and collapsed living standards despite massive natural wealth. Printing money does not create prosperity. It redistributes it upward and outward until trust breaks. When trust breaks, velocity accelerates and control is lost. That's why stage 4 is never gradual for ordinary people. It feels sudden because the damage was building quietly for years. Assets that once felt safe fall together. Stocks, bonds, real estate, all dependent on cheap money, deflate simultaneously. Banks face liquidity crises. Pension funds discover they were built on unrealistic assumptions. Governments impose controls, restrictions, and emergency measures to stop capital flight. Always too late. And the hardest truth of all, the middle class absorbs the shock. Not the ultra-rich who diversified early. Not institutions who repositioned during stage 3, but savers, workers, retirees. People who trusted the system to remain stable because it always had before. This isn't prophecy, it's precedent. Every reserve currency collapse followed this exact sequence. The timelines varied, the technologies changed, but the outcomes never did. That's why recognizing stage 3 matters so much. Once stage 4 is visible to everyone, preparation is no longer preparation, it's reaction. And reaction is expensive. The reveal isn't that collapse is guaranteed tomorrow. The reveal is that the path is already defined. And history shows that once a system reaches this point, outcomes are driven less by choice and more by inevitability. The only variable left is positioning, and who understands what phase they are reliving in before the crowd does. So what does all of this mean for you? Not governments, not banks, not politicians, but you sitting here right now. It means this is no longer a time for passive optimism. It's a time for awareness and positioning. If most of your savings, income, and future plans depend on a single currency and a single system, you're taking a risk whether you admit it or not. And the dangerous part is that this risk feels invisible while everything still looks normal. Diversification is no longer a buzzword used by financial advisors. It's a defensive strategy. Spreading exposure across different asset types, different regions, and different stores of value isn't a T about getting rich. It is about staying solvent when conditions change. History rewards flexibility, not blind loyalty. Liquidity matters more than comfort. In periods of transition, the people with options survive best. When assets reprice, when opportunities appear suddenly, those who can move quickly are the ones who adapt. Those locked into rigid structures are forced to react too late. But beyond money, there's something even more important. Skills, knowledge, and relationships. Systems reset, currencies weaken, but human capital endures. The ability to create value, solve problems, and adapt to new realities has survived every collapse in history. This isn't about panic, it's about preparation. The institutions already understand this. That's why they're moving quietly. The question is whether individuals will pay attention while there's still time to act calmly instead of desperately. If this perspective challenged how you think about money, drop a comment below, share what stood out, where you agree, where you don't. I read every comment. And if you want to stay ahead of the cycle instead of reacting to it, make sure you're subscribed, because the next breakdown goes even deeper. History doesn't repeat perfectly, but it rhymes with brutal consistency. 500 years, 3 empires, 1 pattern. Right now, every signal points to the same phase that came before every major currency transition. The silent movement, the quiet repositioning, the calm before acceleration. The question isn't whether change is coming, it's whether you'll recognize it early enough to act with clarity instead of panic. In the next video, I'll break down which assets historically survived currency collapses, which ones failed completely, and why certain sectors consistently outperformed during monetary resets. Because understanding the pattern is only the first step. Positioning correctly is what separates survival from regret. Subscribe, stay alert, and remember, the people who make it through these transitions aren't always the wealthiest. They're the ones who saw the cycle clearly and acted before the crowd.